Alrighty, traders, welcome. Today I want to cover really what I consider the dynamic duo of trading strategies. In fact, I feel so strongly about both of these strategies being an integral part of your portfolio. I think you can run a portfolio very, very much on just these two strategies and maybe not have to do anything else. And the way I trade them, they're fairly long-term and evolving, so there's not a lot of management and a lot of work involved in it. So let's dive in and let's see what these look like when we get into them. So why is this the way? Well, number one, we're always looking for consistent monthly income. And I want consistent monthly income. I want it to be mechanical. I want it to be repeatable and consistent. And I love simple mechanical trades. I don't want to do a whole lot of guesswork and trying to figure out how to adjust this and when do I put it on. I want trades that allow me to just dive right in, get going on the trade, and not have to do a whole lot of complex thinking on it. Which leads us to the next one: is there's no complex technical analysis needed. These trades, for the most part, are largely TA resistant. You really don't have to look at what the market's doing. Today, we're in a pretty nice little selling mode. We've been in a selling mode for several weeks when this video is made. Here, it's all good. These trades are pretty resistant to that. And if you trade the right underlyings and you set these up correctly, I think you're going to find that you really didn't need to do a whole lot of TA to figure this stuff out. The great thing, too, is that these can absolutely be scaled to any account size, whether you're running a $10,000 account or whether you're running a $50,000, a $100,000, a $500,000, a $1 million account. Doesn't really matter. You can scale these trades to fit any size account with different underlyings. So we'll talk about that. And they also have a very, very high win rate. You're talking 90, 95% win rates on both of these trades. Obviously, when you've got such high win rates, you've got some decent risk in there as well. But we're going to talk about some risk and some leverage when we get into these particular trades. And when you couple these with futures options, they're really a deadly combo. I recommend using these on futures. Again, I don't care if you have a $10,000, a $50,000, or a $100,000 or $200,000 portfolio. It doesn't matter. Futures is what these are built for, to take full advantage of. You get fantastic leverage on futures, and you can get some great diversification using futures as well. So let's get into the dynamic duo of trading strategies for me. And these are two strategies. Number one is Strangles on futures. Love Strangles on futures. We're going to talk about these first. Then we're going to get into the long-term 112 using ES or MES futures. So let's dive into it. So Strangles. I don't need to go through, hopefully, a lot of this with you, but basics of a strangle. We sell both a call put or a call option and a put option in the same expiration, obviously with different strike prices. We expect that the underlying asset is going to stay somewhere in this range until expiration. On the call option, we're going to sell a far out of the money call. And on the put option, we're going to simultaneously sell that far out of the money put option. We're going to generate income at the beginning of this trade, and we put this on because we're selling both of these options at the same time. And the way we lose is if the underlying price significantly moves in one direction or another. And we're going to help work on that as we look at some diversification of product and diversification of days to expiration and strikes as well. So let's get into the trade entry for the Strangles. Again, I prefer 90 DTE. I start around 7 delta on the puts. I look at about 6 delta on the call side. Depending on your account and depending on some of your risk tolerances and depending on what's going on in the market, you can move those around. I have, on smaller accounts, I've been doing it a little bit lower, more like 4 to 5 delta. On larger accounts, maybe I'll go up a little bit higher than that, but not typically. I like the safety. I like where those are. And I'm going to size these so that the max loss of any of these would be about 2% of your net lick. So we'll talk about that when putting these on. And when I'm trading Strangles, the futures that I like are oil, CL. I like gold, GC. the Aussie dollar, 6A, the British pound, 6B, the Euro futures, 6E. I also like hogs and live cattle as well. So that's the HELE trades here that you can put on. There are other underlyings. These are my favorites. It doesn't mean you can't use something else. If you want to use copper or any of those other ones, you certainly can do so. All right. Exiting for me on Strangles, pretty simple. I exit for a 2x loss, which would be a 3x stop. And I look to take profits at about 50% of the credit that I receive on these trades. I'm also going to look to exit potentially at about 21 days till expiration to avoid any gamma risk in the trade. It's rare that that happens, but that is part of the trade plan. I don't adjust my strikes during the trade, nor do I really roll unless I have no choice in the matter. I'm not going to roll the untested side in. I'm not going to roll out in time. I'm not going to do any of that stuff. Okay, I'm going to put it on. I've got an exit strategy. I'm going to stick to it. If I need to, and I'm comfortable, and you're comfortable, you could take assignment if needed. Typically, you're going to get a fantastic price. Being that we're at 7.5 delta, whatever, you're going to get pretty far away from the current price. So if you do get assigned, you may find yourself in a great opportunity to trade or wheel your way out of it. All right, so let's look at some of the return on capital for Strangles and how we set these up. If I'm looking at oil, CL, one contract would generate about $780 worth of credit using about $28.29 in buying power. Gold, 790 credit on 32.36 in buying power. On ES, I can get about $1,275 on 3,321 in buying power. On 6A, 5 contracts nets me about $800 on 1940 in buying power. If I'm looking at 6E futures, 3 contracts would net me about $825 on 1,838 in buying power. So it gives you a sense of, if these are all similar in size, you're averaging somewhere around, I'm going to call it $3,000 in buying power. Some of these are less, some of these are more, but let's look at the average. So I'm going to use about $3,000 in buying power, and I'm averaging somewhere in the neighborhood of $800 on most of these on 3,000 in buying power. So you get pretty good return on capital, which is why futures are fantastic. They are my favorite thing to trade because I get awesome leverage in there and I get some diversification. I'm not just trading a bunch of correlated stocks, even though there are some correlations between oil and gold and ES and the Aussie dollar. And they're all a little bit dependent on the US dollar as well. However, they are very different underlyings. And I'm always shooting for 50% of these credit numbers. So you cut these credit numbers in half. That's what I'm looking to take out. So if you're doing some math, I'm going to take out about $400 on that $3,000 in buying power that I put into this trade. And most of these Strangles at 90 DTE come off in approximately 30 days. Some can come off in 20 to 25 days. Sometimes they take 40, 45 days. But on average, I'm in and out of these trades in about 30 days. And that's going to be important for you in just a minute. So there's our Strangles. And let's take a look at what one looks like. This is a typical setup on CL. I did use 3 contracts on this particular trade, but you can see exactly what we're looking at here. We've sold both the puts and the calls pretty far away from the center strike that we have here. And as long as we stay anywhere between those in that whole green area, okay, we're going to see a profit on this trade. All right, so that's what a Strangle is going to look like. That's how we're going to set these up. Now let's take a look at the 112 trade. So with the 112, we start by buying an out-of-the-money put spread on the underlying, and then we're going to sell 2 naked puts farther out of the money to pay for that put spread, and then some, giving us a nice credit for the trade. The goal of this strategy is to collect premium, coupled with ways to make even more money if we have a decent sell-off, 5, 10%. Sell-off, maybe 15, maybe more in the market. So if we have a decent sell-off over a period of time, okay, we're going to see even more money from these trades. In addition, it's also a way to purchase the underlying for a very steep discount if you're okay with buying the ES or MES futures. The trade will make a profit in two different ways. Number one, in the tail. The tail is essentially the credit you receive. So if they expire and this thing doesn't tank, it's unlimited, or I said it's limited risk. There's no risk to the upside at all. And you do have some risk far downstream. But in order to get to that risk, you've got to go through this big fat trap, which gives you your second way to make profit. So you've got the tail, which is your credit, or if it falls below our put debit spread, now we make even more money because not only do we keep the credit, but we get the difference in the strikes of the put debit spread, which is typically about 50 wide in there, which is going to give us, on using ES, another $2,500 or so on top of the money that we take in. So let's take a look at how we construct these. Number one, this is the long-term 112. So I'm going to change it up a little bit from the standard 112. We go out about 120 days on these. The farther out we go, the more we remove the effects of gamma on the trade. Farther out expirations also provide a lot more premium. They also provide more distance from the money, so giving us a little safer trade. They're also going to use less buying power per the time frame that you're in. A 60-day 112 versus a 120-day 112. Now, the 120-day 112 is going to use, obviously, more buying power, but when you divide that by the 4 months that you're in the trade versus 2 months on the 60-day, that buying power is a lot lower percentage, which is going to make this trade even more valuable to us. And I'm going to use ES futures for this trade only in this example. This is what I normally trade, is ES futures. You can also use MES futures, the micro E-minis, depending on your account size. You would need an account size of over $50,000 in order to use ES in this trade strategy. And I'm going to suggest that you probably not be able to do this using ES if your account is under $100,000 for this particular strategy that I'm going to talk about. All right, trade entry, again, we buy that put debit spread. That's the 1-1 in the 112. We start around 25 delta on the long puts. We go 50 wide. We take in around $8. And then on the naked puts, we drop down to around 5 delta, and we're going to take in around 15 to 17 bucks for each of those contracts. So overall, you're looking at the naked puts bringing in $30 to $34 in credit minus the 8. You're somewhere around $22, $23, $25 in credit for each ES, which is a 50 multiplier, by the way. So something to bring in mind. Now, how do we get out of the 112s? Stop loss is 1x the max profit in this trade, unless you're willing to accept assignment at that steep discount. But typically, I'm going to look to exit out of this trade if we end up at a loss that's equal to the max profit that we would have had in the trap. Otherwise, I'll let this thing expire for a 100% winner is another way to exit. I can also exit for max profit in the trap if I'm near expiration. My usual way of exiting this is I will usually close those naked puts when they get to 95% of the premium capture. So as soon as I've captured 95% of the premium, close the naked puts, remove the buying power, remove all of the downside risk, and now you have a free put debit spread hedge that you can let go. Okay. There are other adjustments that we can make on these put debit spread depending on price and time. I'm not going to cover all of those here, but there's a lot of unique ways to trade this and improve this trade once you get it on. Okay, but I'm giving you the basics of the trade. And here's what these look like. So if you're putting on one on ES, this is typically what we look like. You can see the put debit spreads at 4150, 4200, and then you can see the naked puts down at 3450. So you can see we get quite a bit of ways. The underlying right now is around 4450, and we're selling the 3450. We are 1,000 points down on our naked puts. That's a pretty far way for this thing to fall to put us in any type of trouble. All right, and you can see on this particular trade that we're getting approximately $27 on one contract. Now, $27 on this contract will give us about $1,350 in credit. And you can see the buying power on this is about $47.93. So not quite 5,000 on ES. So it's pretty nice to take in $1,350 on $4,700, $4,800 in buying power. So it's a 25% return just on the credit alone in 4 months. That's pretty nice. That's giving us close to 6% a month. Not too shabby. All right. So let's look at the return on capital of these things. Just like we did with the Strangles, one tranche of ES is going to net you, again, about 1,440 credit using around $5,000 or so in BP. You can see from the example that we just did here, we were able to take in around 1,350 on about 4,800. So all depends, but somewhere in that range as is what you can expect on using ES. So we'll use 1,400 on about $6,000 in BP. All depends on your brokerage, obviously. And then MES, if we're going to scale down, use the micro E-minis because we have smaller accounts, one tranche of these is going to give you about $125 using 750 in BP. Again, a pretty nice return in 4 months. That's your minimum return if this market stays above your naked puts. You could get more if you fall into the trap. So you could potentially get another gigantic bump on this trade if we land in the trap. So use the underlying and use the number of contracts that makes sense for your account size. Note, we're going to ladder between 4 and 8 of these over 128 days. So as I'm figuring out the buying power, you got to multiply those times at least 4 trades if you're doing 1 a month. If your account's bigger and you can do 2 a month, because those 120-day expirations come out roughly every 2 weeks, you could put a new one on every 2 weeks, which would give you up to 8 on at a time. But again, you got to make sure you have the buying power to be able to pull this trade off. Putting that many on, I'm going to use a little simpler explanation here. So let's talk about the strategy. How do we use this dynamic duo strategy of Strangles on futures and the ES or MES 112? And we're going to take an example, a $50,000 account. I had a request for how do I set up a $50,000 account today. This is what I would tell you. This is how I've got some of my kids' accounts set up. This is how I have other people's trades set up. This is how I have some IRAs set up. You can sprinkle in some other strategies in here, but this is going to create the core. This is going to give you a fantastic monthly return with very little management. So let's assume a $50,000 account, and we're going to use up to 50% of the buying power in this account. So I'm going to use 50% of the 50K in buying power. So I'm going to use up to $25,000 in buying power. I'm going to leave the other $25,000 in buying power open in case for span margin increases. I'm not covering span margin here. You can see that in some of my other videos. You can look up and research span margin. But span margin is why futures has so much fantastic leverage. It's because they're not based upon anything except the risk of your portfolio. The good thing about that is you get great leverage. The bad thing about that is as the risk of your overall portfolio goes up, it can really increase the cost of the individual futures or the price of the futures you're using. And you want to leave a nice buffer for days like today when the market's selling off pretty good and IV's rising and you see your buying power starting to expand. You want to be able to have extra room for that. You don't want to be using 100% of the buying power that you have. Okay, so based on that 25,000 buying power, I'm going to allocate roughly 50-50 in this case. So I know in some of my videos I use 33% or so. This is a little bit of an exception. I'm going to use half of my 25K, which is half of my full buying power for each strategy. So $12,500 for each strategy. I'm going to look to put on 4 Strangles and 4 of the long-term 112 trades in this account using $12,500 for each of these strategies. Let's see how we do it. Okay. All right. So here's the portfolio. Hopefully you can read this, but 4 Strangles. If I put on 4 Strangles, again, I'm averaging $800 in credit on each, using about $3,000 in buying power each. So if I put 4 of these on, okay, I'm going to use $12,000 in buying power. That's going to put me right inside my 12,500. I'm in good shape. I'm going to take in $800 in credit on each one of those. Okay, so I'm going to take in on 4 of these $2,400 in credit. I am going to assume here that I'm going to close roughly 2 of these a month, which means on 90-day Strangles, we talked about earlier, we average about 30 days in trade. If you put on roughly 1 a week and you laddered up to 4, and every time 1 comes off, you put another 1 on, you've always got 4 running, you can assume that every 30 days, at least 2 of these are probably coming off. Okay, so we're going to keep it there, which means you're making, $800 credit each times 4. Okay, but if 2 of them come off at 50%, that's $400 each. I'm going to make $800 a month in income just on the Strangles alone. Now let's look at the 112s. Now the long-term 112 trade, I can't afford in this account to use ES, because as we've talked about, ES is going to use about $6,000 in buying power for just 1 tranche. Okay, too big. I need 12,000. I have only 12,500 to work with. I got to stick under that. So we're going to use MES. I'm able to use 4. Okay, so we're going to use 4 MES contracts of each of these 4 tranches. And as I mentioned before, an MES contract or tranche is $125 in credit using 750 BP for each 1 contract. Using 4 contracts, and there's the closing bell for the day, using 4 contracts, I'm going to generate roughly $500 in credit on each one of these, and I'm going to use about $3,000 in buying power for each one of these. So multiply that by 4. I'm going to take in roughly $2,000 in credit, and I'm going to use about $12,000 in buying power. That's buying power to start with. Okay, I'm going to assume that I'm going to close 1 per month. Okay, so if you ladder these on every single month, okay, once you've got 4 running over a 4-month period of time, on month number 5, 1 of those is going to expire, and you're going to add another one. So always taking 1 off, putting 1 on every month. I'm not even going to complicate it with the fact that if I took the naked puts off at 95%, that I could put a new one on quicker, which you can, but let's be conservative here. I'm going to make $500 in income minimum on this trade as each one of these comes off. I'm using 4 contracts, $125 in credit times 4 contracts, $500. Those are coming off every single month. So now I make $500 on these every month. So totally, I'm now going to generate around $1,300 a month on $25,000 in buying power. So I'm generating about 5.5 or 5.2% a month on capital. It's a nice gain, but that's not on the net lick of the portfolio. Because I have a $50,000 portfolio that I'm working, you're going to have to cut that number in half, but it's totally fine. We're looking at 2.6%, almost 3% a month more if you actually fall into the trap on the 112s. So this is a great way to generate 2.6% a month. At 2.6% a month, you're going to net about 31.2% a year just using these 2 strategies. Okay. Will you have a loss in there? It's possible. Will you have some more winners in here? That's also possible. Will you be able to take them off sooner and add more trades? That's also possible. I'm giving you a foundational trade. I'm not saying that you'll never have losers. I'm also not saying that you won't be able to add more trades on and add more winners. And then also understanding that my buying power and my trades, my account size is going to continue to grow each month. Every month, I'm adding at least $1,300 to my account. In 3 months or so, I've added at least $4,000 in buying power, which is $2,000 that I would use at 50%. Okay, what can you do with an extra $2,000? Well, now you can start to potentially lay on more of the 112 trades to get up to that 8. Maybe by the time that I've generated 6 months worth, Okay, now I've generated another $8,000 in size. I'm using half of that buying power, that's 4,000. I could potentially put on one more Strangle and one more LT112. So now you're starting to add and grow. That's my take. Again, the dynamic duo of trading, Strangles on futures, long-term 112 trades. If you figure out how to put those on together, that's all that you need right now. You get a little bit of a hedge, you get a very high win rate, you get uncorrelated, for the most part, assets using oil, using gold, using lean hogs, using live cattle, any of those offsetting the fact that you're using ES there. So I'm not just S&P based, I've got other trades in other sectors that I have working on as well. All right, that's it for today. I hope you got a lot out of this strategy, something to take a look at. If you like this video and you want to see more of it, please go ahead and click that like button. Go ahead and subscribe to this channel, trying to give you some more, and click those notifications so you can see when I'm trading and what I'm posting. All right, guys, have a great rest of your day. Bye-bye.